Good evening, everyone. Welcome to our webinar on how to unlock tax advantages and supercharge your wealth. I'm Chris Parinello, the Director of Investor Relations for Viking Capital. Tonight, we have a special presentation that revolves around tax arbitrage and the use of passive losses to keep more of your hard-earned income. In addition to bringing an expert in the field who will present many strategies, nuance, and loopholes to the IRS tax code, we have also crafted several case studies, all based on current investments into our latest deal Stewart's Mill. I'd bet that 90% of you will fall into one of these investor scenarios. Tonight, I will be joined by our CEO, Vikram Raya, and a very special speaker, Brandon Hall. I know many won't be able to watch the webinar in its entirety. Don't worry, we'll be sending out the replay and a condensed version of the deck tomorrow. Many of you have sent in your questions, but feel free to add questions to the queue. We will be answering questions here at the webinar. My investor relations team is in the chat room to help get as many answered live tonight. Without further ado, I'd like to introduce you to renowned cardiologist, international speaker, founder of Limitless MD, and our very own co-founder, CEO, Vikram Raya.
Thanks, Chris. Really appreciate it. How's everyone doing out there? Really excited. Let's check in the chat right now. Just do me a favor. I want to make sure the chat's working for everyone out there. If you can just put in where you're from, anyone in the country, that'd be great. Great. Hamid, hi. Amir. Sanjay's from Chicago. Awesome. We got McLean, Virginia. We got Houston, Northern New Jersey. Anil from Austin. Norm from Maine. Awesome. Brandon, we got a full house tonight, my friend. We got people from all over the country. That's exciting. Guys, I really wanted to do something before the year ended. So if you wanted to make some strategic tax moves, now is the time. And so I brought my good friend and fellow Inc. 5000 member, Brandon here. And, you know, he's a friend. He's obviously the founder of Hall CPA, which, you know, is one of the top leading firms in the country for obviously tax strategy, but really in the field of real estate. And, you know, his podcast is, you know, syndicated and thousands of downloads every month of people getting valuable tax advice from him. He's coached and trained some of the top, you know, business owners in the country in how to protect against taxes and do it the right way. He's helped people achieve the real estate professional status. In fact, his company is sort of nicknamed the Real Estate CPA. So he's really done so many things in the field. And I wanted to bring him today so we can answer your questions so you can get the most benefits from one of the leading experts in the United States on tax strategy. And so I'm super pumped and excited to have him on. And if you guys have questions that have come up even in the last 5 to 10, 15 minutes, go ahead and put in the chat or the Q&A. And my team is going to curate all those questions. And we'll have a session at the end where we already have some questions that you guys have already submitted to us, but we'll have a few more that we have a time for. Okay. And so guys, please take advantage of this. This is the time to really ask for strategy and guidance, because it's not about how much money you make, as you guys know, it's how much money you keep. And you may be wondering, hey, you know, what's the big deal? What's going on in the economy, in the world, that we need to really be strategic? And so it's an interesting time out there, as you guys know. We're in a different economic cycle, right? We've had 8, 9, 10 years of expansion, and now it's sort of a somewhat contraction. It's not a 2008, 2009 by any means, but definitely there are some headwinds. And so it's really about the people who are strategic, who are smarter, who are financially resilient, and who are empowered, who are going to make the right decisions, right? Most people are putting their heads in the sand and waiting for the storm to pass. Other people are playing checkers. I want you guys to play chess. Next slide. And so, you know, one of the things we've done is always get the best CPA we can and really look into the best tax strategies, both for our investors like you guys, for our personal company, and for the real estate assets that we own. And so we encourage you to do the same. And so during the talk today, we're going to talk about how to build and keep your wealth, how to stop paying outrageous tax bills, and how to use your passive income to offset taxes. And there's some little known tax strategies that Brandon's going to really drop some knowledge bombs on you today about that are going to really help you. I mean, I don't know how many countless investors I spoke to over the last 2 months where they're like, oh my God, I just had this huge tax bill. I guess I just have to pay it. I'm like, wait a minute, what kind of income is it? Have you thought about this strategy? And they're like, no one has ever told me that. My CPA had never told me that. Oh my God, that's a $200,000 turnaround, right? So these are the things that I want you to pick up today from Brandon, and hopefully maybe some of the questions that are going to be asked on your behalf will help you as well. So let's unlock the power of tax arbitrage, stop leaving money on the table, and let's crush this year's tax season. And with that, my friend Brandon, the floor is yours.
Thank you very much. I really appreciate it. Hi, everybody. My name is Brandon Hall. I own Hall CPA. It's a national accounting firm that niches in real estate. So we work with real estate landlords, large and small. Small being like high income earners that are buying their first rental. Large being very large private equity funds. I think our largest is $1.5 billion. So we provide tax strategy, tax compliance, and also a lot of outsourced accounting services. So as your portfolio scales, how do you really kind of keep your finances in check? That's what our team can kind of come in and help you do. So we've got some slides prepared. I'm going to jump right into it and continue on with this presentation. But if you've got any questions as I'm going, please use the Q&A button down in Zoom. That'll really help us kind of consolidate things. And I know we've got a lot of questions to get to, so I'm going to get rolling on this. So top three destroyers of wealth. I think the number one is taxes, right? But you're all real estate investors, at least if you're on this webinar. So you have the opportunity to change that and mitigate your tax exposure. So we're going to talk about what happens when like you can save money on taxes, reinvest that, redeploy that capital that you've saved, and just continue that wealth snowball, right? So you get it rolling downhill and it's going to get bigger and bigger and bigger as it goes. Another destroyer of wealth, 401k and IRA plans, I'd say here, if they are mismanaged. So a lot of times what happens with 401k and IRA plans, at least with our clients, is we kind of just set it and forget it. And, you know, there are, I guess, merits to that. It's super, 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 super passive. But if you aren't kind of looking at that on an every 6 to 12 month basis, your allocations get out of whack. You might not be fully optimized in your investments that are inside of your 401k and your IRA plans. And then obviously stock market losses are a great way to destroy wealth. So would be really any type of loss, but we see it a lot with the volatility in the stock market. When it starts going down, it's very easy to click that button to sell. Versus like investing in real estate where you're locked up and you can't just liquidate immediately, which comes with its own set of risks as well. All right, we'll do next slide. All right. Let's do the next slide. Yeah. Okay, so when it comes to like your taxes, right? You have your active income and then you have your passive income. Your active income is your W-2 job, your business income. You're going to be paying 40% on that. And that's going to like factor in state taxes. You also have to factor in payroll taxes. A lot of people don't recognize all the things that they have to start factoring in here. So when you earn an extra $100,000, $200,000, $300,000, you're also paying the government their slice of that. When you invest in real estate, and when you can use cost segregation studies and bonus depreciation, when you can deploy a strategy under the passive activity loss rules that optimizes, you might be able to save some of that from going to the government, or you might be able to claw some of that back over time. Next slide, please. So the beautiful thing about real estate, and if you listen to our podcast or if you've read our content, you already know where I'm going with this. But the beautiful thing about real estate is we have a non-cash expense called depreciation. All right. So if you go and you buy a rental property for, say, $100,000, we have to allocate some value to land because land is not depreciated. It doesn't deteriorate over time. It's dirt, right? It's still going to be there 200 years later. But the building itself literally falls apart. So even though the value of the building increases with the market over time, the components that make the building up literally fall apart. So depreciation is an expense meant to give you a benefit or I'll call it a credit for that falling apart of all of those components. So it's a non-cash expense, meaning that every single year I get to claim an extra expense on my P&L, on my tax returns, thanks to simply owning the real estate. And it doesn't matter if I bought the real estate all cash, or if I paid, or if I put $0 into the deal and it's 100% financed, or if it's 70-30. It doesn't matter how I structure the actual acquisition, the depreciation expense is going to be calculated the same way. So on a $100,000 acquisition, where maybe $90,000 is the building and $10,000 of that value has been allocated to land, I'm going to depreciate that $90,000 over 27 and a half years. So to calculate my annual depreciation expense, it's simply $90,000 divided by 27 and a half, which I think is like $3,100 or $3,200 a year. So every single year, I get to claim this extra $3,200 expense called depreciation. And what that really does is just helps consistently shelter my cash flow from taxes, right? So if I earn $3,000 on my rental property and then I have a $3,200 depreciation expense, then even though $3,000 hit my pocket, I get to tell the IRS that I actually lost some money. We've actually got an example coming up that we'll go into with this. But I also want you to understand that when you invest in a syndication or in a fund that is investing in real estate, you get the same benefit, okay? Because a lot of times when our clients invest in syndications and then they get this K1 back, and it says $80,000 tax loss on it, and then we prepare the tax return and they can't actually use the tax loss, which we'll also talk about in a second. They get mad, especially if they're a first-time investor, right? They go, why would I invest in real estate if I can't use this tax loss? You just told me it gets suspended and carried forward because it's passive. I don't even understand what those rules mean, but I wanted to use the tax loss. I wanted to benefit from investing in real estate. And what we explain is you might not be able to use the tax loss against your regular income because you aren't meeting some of the exceptions to the passive activity loss rules, but you're still benefiting from depreciation even when you're investing in a syndication or a fund because they have the same economics, right? They've bought this building for $10 million and they're depreciating $9 million of it versus the whole 10, right? And then they're getting $300,000 of depreciation, and then they're doing cost seg studies and bonus depreciation. So the syndications and the funds, they're earning income, they're earning net operating income, and they're using depreciation to offset that. And you're getting a little slice of all of that. Okay. So you're still benefiting from a tax perspective, even when you invest in syndications and funds, even when you can't use the losses for to offset your active income. So the same thing is going on, but you're just getting a smaller slice of it. Next slide, please.
And I want to stack on that, Brandon. They can't, they are getting distributions from the property. And so that some of that depreciation, as I said, all of that income can be potentially tax-free coming in.
So the way that the distributions work, so yes, yes. The way that the distributions work is everybody has a capital account when you invest into a syndication, right? So if the three of us all put $100,000 into a partnership, we all have a $100,000 capital account. I can withdraw $100K and not pay tax on it because that's how much money I put in. Now, the interesting thing about syndications and funds is that I as a partner also get allocated a share of the debt that these syndications and funds place on the property, which increases my capital account. So we could all three put $100K into the property, but then we get a $300K loan and we all get allocated a $100,000 debt, non-recourse debt allocation. They call it Q&R. Because of that 100K allocation and the 100K that I put in, now my capital account's 200K. So now I can take a $200,000 tax distribution or a tax-free distribution from the property. Yes, you're correct. That was a little bit of a deeper dive, but that's how it works. Yes. All right. So benefits of depreciation, kind of explain some of these, but you shelter current cash flow. Okay. So if I buy the 100K property and I net $3,000, but I get to tell the IRS that I have this extra $3,200 expense, so I really lost $200 from a tax perspective. If I can do that 10 times, now I'm netting $30,000, and I'm telling the IRS I lost $32,000, right? I'm sorry, I'm telling the IRS I lost $2,000 because I get a $32,000 depreciation expense. If I can do that 10 more times, now I'm netting $300,000. I'm telling the IRS I had depreciation of $320K. So even though I earned $300K, I'm telling the IRS I lost 20. So depreciation is beautiful in the sense that if I can multiply my portfolio, I can very legitimately receive cash and not pay tax on that cash today. And I can do this. I don't have to necessarily own the property by myself. And it doesn't even necessarily have to be real estate that we're talking about, right? It could be ATM machines. It could be passive investments in businesses and things like that. So, and we'll talk a little about that as well. But the point is that depreciation on my rental real estate shelters all of this passive income that I'm earning, whether or not that passive income is generated from a rental activity. That depreciation can shelter it. So I can create a lot of I can play this game on 4D chess, if you will, where I can have all this nice passive income and I can have all of this depreciation coming in that offsets it, if I structure it right. And to structure it right, when I acquire some real estate or when I invest into a syndication, they're going to use cost segregation studies, which is going to give me bonus depreciation. And it's also going to allow me to accelerate depreciation in the event that I cannot use bonus depreciation, or in the event that bonus depreciation is phased out and I can't use the full 100%. So cost segregation study, if we're talking about our $100,000 rental, after I do that initial allocation of 90K goes to the building, 10K goes to the land, a cost segregation study is the practice of saying, that's great that you have $90,000 of building value, but the reality is that there's a whole bunch of things, there's a whole bunch of components that go into this $90,000 building that are going to be depreciated over a much faster timeline than 27 and a half years, because they're not going to last 27 and a half years, right? So things like carpet and fixtures and appliances. A cost segregation study is going to go through your property and it's going to pull those things out and it's going to give them a 5-year, 7-year, or 15-year life. So after a cost segregation study is performed, you'll have some of that 90K value allocated to 5-year property, 7-year property, 15-year property, and then you'll still have some remainder in this 27 and a half year property bucket. And now what you're able to do post cost segregation study is you can depreciate these components over 5 years, 7 years, 15 years versus 27 and a half years. So if you take $10,000 of carpet as an example, $10,000 divided by 27 and a half years is, I don't know what that is, $300, something like that. I don't I love using examples where I don't know the numbers off the top of my head, but you get it, right? $10,000 divided by 27 and a half years, something like $300. If I do a cost segregation study, I can do $10,000 divided by 5 years, and now I get $2,000 a year instead of $300 a year, right? So I've increased my depreciation expense by $1,700 a year for the first 5 years. And then after that 5th year, my depreciation is 0 on that carpet because I've fully depreciated it. So a cost segregation study allows you, and by the way, if we have any accountants on here, I know that's not technically how it works, but just, ease of examples. One time I got called out for it. They were like, hey, that's not how it works because you're supposed to use double declining balance for 5-year property. So there's the technical thing. So just in case, cover my butt. But $10,000 divided by 5 years, $2,000 a year is what you're looking at. And then $0 starting in year 6. So that's what a cost segregation study allows you to do. But bonus depreciation comes into play because we can immediately expense a percentage of all of the components that have a useful life of less than 20 years. So if a cost segregation study is the practice of taking 90K from the building and allocating it to 5, 7, and 15-year property, 5, 7, 15-year property is all less than 20, right? So that means that all of that value is eligible for bonus depreciation. Bonus depreciation in 2022 was 100%. In 2023, it's 80%. In 2024, it is 60%. We have a little chart that's going to show you how it continues to phase out. So why would anybody really want to accelerate depreciation? Because sometimes we get questions on this. It's like, well, I heard about depreciation recapture. At some later point, you got to pay it all back, which is true, right? So why would I want to take depreciation now and just have to pay it back later? Well, there's a couple of reasons, but the main reason is time value of money. Nobody here, actually, this would be a good question. So in the chat, give me a 1 if you type 1 if you would do this thing I'm about to ask, 0 if you would not. If I gave you $500,000 today, how many of you would put it into a checking account earning 0.5% a year? 1 if you would do that, 0 if you would not. Right, 0. Of course we wouldn't. Why would we ever do that? We know we can redeploy that capital into a lot of different sources that are going to earn more than 0.5% per year, right? But the same thing's going on with your rental property. If you go buy a rental property today, I can literally pull up a spreadsheet and show you what the tax benefit is to you that you're leaving in that rental property if you don't pull it out with a cost segregation study. And you are effectively doing the same thing. I'm leaving money in this account. Yeah, it looks a little bit different, but it's the same concept. I'm leaving money in this account that's earning basically $0. So why would I do that? I'm going to pull the money out. I'm going to redeploy it. And I mean, even today, you can do risk-free treasuries for like 4.5%. So I'm going to redeploy that capital and I'm going to earn a return on it. And so, yes, one day I will have to pay that capital back, but I've earned a return on it throughout the way, right? If I don't do that, then over time, inflation is chipping away at the real value of that $3,200 a year in depreciation expense that I'm getting, right? Today, it's $3,200 in real terms, but next year, the cost of milk's gone up another 5%. So that same $3,200 depreciation expense that I get to show on my P&L really isn't worth $3,200 anymore, right? It might be worth $3,190. The next year, same thing. We're going to have that erosion. So even though it shows $3,200, I know the real value is decreasing thanks to inflation. All right. So anyway, point is, we like to strip the value. We like to strip the tax savings out of the property as fast as possible. Depreciation helps us do that. Cost segregation studies accelerate that. Next slide, please. All right. So I mentioned bonus depreciation is phasing out. So 2023, bonus depreciation is at 80%. So when I do that cost segregation study and identify all that value that's allocated to 5, 7, 15-year property, I can take a deduction for 80% of it immediately. The remaining 20% of it is depreciated over the 5, 7, 15-year lives. Next year, starting January 1st, 2024, for any property that you purchase and place into service, you get 60% bonus depreciation, okay? 2025 is 40%. 26, it's 20%. 2027, it is 0%. I have heard rumblings of some grassroots legislation that might be coming up about trying to extend bonus depreciation. So there is some talk about it, but I also think that, you know, it's a political leverage tool. So next November will tell us a lot around whether or not bonus depreciation will be extended or not, right? So that's what we're all kind of watching at this point. Is next November, is there going to be any sort of last minute legislation that changes this? We don't know, but right now it stands to completely phase out by 2027. Now, this doesn't mean that cost segregation studies and accelerated depreciation are going to be worthless, because we get that question sometimes. Well, I'm never going to do a cost segregation study again. No, like even if you have 0% bonus depreciation, you can still do a cost segregation study and depreciate that same carpet over 5 years versus 27.5 years, right? So you're still going to benefit. It's just that the value of the cost segregation study is also eroding every single year. So it's good to go ahead and get into a property now, to place it into service now. And the pro tip is you don't even have to bonus depreciate it right now. You don't have to cost segregate it right now. All you got to do is buy it and place it into service as a rental. And then at some later point, at some future year, when the passive activity loss rules align in your favor, then you can do the cost segregation study and you can bonus depreciate it at that point. You have to file something called a Form 3115, but you can take all of the bonus depreciation that you should have taken back in 2023 when you should have done the cost seg study, but you didn't. So anyway, that's like a side strategy that we use with our clients sometimes. Next slide, please.
All right. Thanks, Brandon. So this is our first case study, and really all of these case studies that we have in here are built off of situations that have come up on this current deal that we've been raising for investors that are using Stewart's Mill to use the depreciation to offset something that's happened this year for them. So in this one, this investor basically sold his business to private equity and decided to take a portion of those proceeds and invest into Stewart's Mill to create a passive loss that they can use next year. The questions that we can go to the next slide. The questions that they gave me to ask you and to really kind of understand, and I think other folks have asked questions revolving around this topic, is are there certain businesses that would not be considered passive, or any kind of business that you sell to private equity? Would you be able to take advantage of the passive losses to offset those gains? What's some of the nuance there?
Yeah. So if you're running a corporation, like a C corporation, then we commonly refer to those as blocker entities. They're kind of like they're off on their own. They're not going to flow through for the passive activity loss rules. But if you're investing or running a partnership, LLC, LLP, something like that, or an S corporation, then yeah, those business, the profits or the losses associated with those business activities will be considered passive or non-passive, depending on your activity in the entity, your involvement in the entity. So this is actually a mistake that we see a lot of times, like especially with the ATM funds, like we'll get a K1 back and it'll show ordinary income in box 1. And accountants that don't fully understand how the passive activity loss rules work will just see, oh, ordinary income, box 1, that must be non-passive. And they'll actually just skip the passive activity losses that you might have, which is not good for you, especially if you're also investing in things that give you these losses, right? So you got to be really careful. It's not about the income type. It's more about it's not about the income type with a caveat, but it's more about what is your actual involvement in the activity? Like my CPA firm is a partnership and I am materially participating in my CPA firm. So it's a non-passive activity, but I could invest 100K into my local hair salon and they could be using that 100K as expansion capital. And maybe they're taxed as a partnership. So now I become a little partner in their company. I'm going to get a K1, but I'm not materially participating. I'm not voting. I'm not operating. I literally just put 100K up. The profits that I receive back from that, those are passive, right? So I could go and invest in rental real estate and create losses from depreciation to offset that passive income from the hair salon.
Got it. And another question that was asked was, if you know that you're going to be exiting some type of activity like this in a couple of years, and we'll probably get into kind of harvesting losses, is that something that folks should be taking advantage of today, or should they just wait until it's more imminent?
Do you mean take advantage of the depreciation?
Right. Like, would harvesting kind of the depreciation and getting it at 80% versus next year, it's harder to get depreciation. Should they be creating kind of a bankroll of depreciation that they can use later, or does it not really matter?
So I'm going to give you the most classic accountant answer possible. It depends. Right? But it really does depend. It depends on your facts and circumstances. Because if you're asking me this as somebody that's in like the 22% tax bracket, well, that's different than somebody that's in the 37% tax bracket. It's also different from somebody that's living in California versus somebody that's living in Florida, right? We have different state tax laws that also we also have to factor in with the passive activity loss rules, with depreciation and depreciation recapture. But what we're really trying to assess here is if we take all this depreciation today and it creates a loss that we can redeploy today with other businesses, do the savings, the tax savings that creates for us, outweigh the eventual depreciation recapture on the deal that gave us this benefit of depreciation? And to answer that question, we have to look at a couple things. First, how long are we holding the deal in question, right? If we're holding the deal in question for 2 or 3 years, maybe accelerating depreciation and taking bonus isn't going to make sense because we don't have enough time to let the tax savings really be invested and grow. But the other thing that we have to look at too, we can't just look at that, right? That is typically the answer of, well, if it's 2 years, don't do it. But we can't just look at that because the other thing we have to look at is what's your overarching strategy. A lot of people don't just do one deal, right? I'll do this deal. It'll give me this big tax benefit. And now I get to use this tax benefit to offset my hair salon income. 2 years later, this thing sells. Oh no, I have depreciation recapture. But do you really? Because you probably did another deal and you probably did another deal and you're probably going to do another deal. And all of these deals are giving you this additional depreciation benefit. So even though this one deal that we're looking at was only held for 2 years, and you would normally say, don't do the cost tag, don't bonus because it's not enough time. But even if that's true, it could still be beneficial for you if you're the person that's kind of earlier on in your portfolio building and you're going to be redeploying into more and more deals, because you're not going to have to recognize the depreciation recapture. You've got all these passive losses that are continuously flowing through to you with every additional deal that you're doing.
Got it. Okay, that's really helpful. I think we can move on.
Cool. All right. Well, we've been talking a lot about passive losses, so let's actually kind of explain it a little bit. You got 100K of rental income coming from your portfolio. You've got 45K of operating expenses. Okay. That leaves you with 55K net operating income. Now, in most businesses, my CPA firm, the hair salon that I keep referencing, most businesses, they're paying taxes on that $55,000, right? So 55,000 minus 0.4, that's what they're left with. If we go to the next slide, in a rental business, it's 100K minus my 45K in operating expenses minus depreciation. So in this example, we've got $60,000 of depreciation on top of my 45K in expenses, meaning that when I do my taxes, my total expenses are $105,000. So if I had 100K of income and then I had $105,000 of expenses, then I have a $5,000 loss, tax loss, not a real loss, not an operating loss, a tax loss. And so then the question becomes, and I actually forgot what the next slide was, but the question becomes, the $5,000 of tax losses, what can I do with that? Can I use that? And when we say, can I use that, we're typically meaning, can I use that to offset my active income? So what we have to do first is we have to answer this question, we have to look at a couple things. First, we have to say, okay, I've got $5,000 of tax losses. Now, do I have any passive income? Because this 5K of tax losses for my rentals, that's a passive loss. So if I have passive income, I can use the $5,000 of losses to offset that passive income. Passive income might be coming from other rental properties that even after depreciation, they still produce income. They might be coming from the sale of a rental property or the sale of a syndication. When you sell a syndication or rental property, the gain is considered passive income. That's a thing that a lot of accountants mess up. But if you look at the regulations under Section 469, it's very clear. When you sell a rental, or when you sell when any passive activity liquidates, any gain on any passive activity, even if it's rental, hair salon, whatever, that gain is considered passive income. So that means that my $5,000 tax loss can offset that gain, or can offset a part of that gain, right? So the first thing that we have to ask is, this 5K of passive losses, do I have any passive income or any gain on sale from passive activities that 5K could offset? If the answer is yes, cool, done. I'm done and I'm just moving along, right? A lot of times, though, the answer is no. And a lot of times we're talking about an $80,000 tax loss, not a 5K tax loss. So now I've got this 80K tax loss coming from some syndication that I invested in. Can I use that tax loss if I don't have any other passive income? To answer that question, we have to look at the passive activity loss rules. The passive activity loss rules say that every rental activity is passive unless you qualify as a real estate professional. So that's step one. The second piece, the second thing that these rules say is any trade or business that you do not materially participate in is passive. Okay. So if I did not materially participate in my CPA firm, it would be passive income to me because it's not a rental activity. So I don't have to worry about real estate professional status. There's only two prongs to the passive activity loss rules. All rentals, unless you qualify as a real estate professional, and any trade or business that you don't materially participate in. All right. So if I materially participate, it's non-passive. If I don't materially participate, it's passive. But if it's a rental activity, I have this extra layer. I could materially participate in a rental activity, but if I don't qualify as a real estate professional, it's still passive. Okay. So that's where all the real estate professional status rules come into play, the material participation tests. We're not going to get into all of them, but you have to look at each one of those to assess, is this truly a passive activity or a non-passive activity? Because if that 80K tax loss ends up being non-passive, then I can use it to offset my W-2 income and my business income. All right. But in the context of this presentation, what we're really trying to assess here is this 80K of tax loss that I have. How can I utilize that in the future? And if you can't use it today, it's okay. It becomes suspended and it gets carried forward so that you can use it in future years. And that carry forward lasts indefinitely. So it doesn't like disappear at all. You just get to continuously carry it forward until you have an activity that produces passive income. Next slide, please. Thank you.
So one question, and this is going to come probably from this case study, but it's on the harvesting idea and being able to carry that forward. I know that recapture comes up, and the recapture event usually happens like in a syndication when we sell the property. That's usually when there's a recapture event. So if you invest $100,000, and the example you use, you get $100,000 or an $80,000 loss on your K1, and then you don't use it for 5 years, and then in 5 years the sponsor sells the property, you would recapture the loss that you didn't use. The IRS probably expects you to have used it, but if you still haven't used it, can you use it still in the future, or did that stop you from being able to use it in the future? Because you would.
So a suspended passive loss can be used to offset any passive income or any gain on sale from a passive activity. So gain on sale from a passive activity, in this case, we're talking about a syndication, right? The syndication is the passive activity. The gain on sale is coming from the appreciation and also from the depreciation. That's the depreciation recapture. All of that is considered passive income under these rules, which means that if I have passive losses, I can use those passive losses to offset that passive income. So yeah, so if I have an 80K tax loss that I never got to use, it's just going to sit on my tax returns. It's going to hang out until I have some passive income, some form of passive income. So if that deal liquidates and I still never use this loss, then I would be able to deploy the loss against the gain on sale at that point.
And even past that,
if I had an $80,000 tax loss and the total gain on sale was less than $80,000 for me, then I would still have excess passive losses. Yes.
Okay.
With the caveat that I might be able to deduct it all anyway. So,
okay. Yeah. Because you have.
So if I can't deduct it all today, then yes, it would continue to carry forward. Most likely you'd be able to deduct it all immediately, unless we're like making grouping elections and all sorts of fun stuff. So,
okay, got it. Yeah, that makes tons of sense.
Yeah. Does it though?
I mean, it does to me.
Okay.
This is something that's
sometimes I confuse myself.
People ask me these questions a lot, and there's some small nuance that I direct them to folks like you to make sure that I'm not leading them, astray. So
a lot of times I feel like I'm talking in circles, man. Just, all the rules that just they point nowhere. Just yeah. Anyway. All right. Am I good to keep going?
Yes.
Okay, cool. So we've kind of already talked a little bit about this. Again, if you have passive losses, you can use those passive losses to offset rental income, to offset my hair salon income if I'm investing in that. ATM machines if I'm investing in those. Again, though, you got to make sure that your accountant doesn't screw that up for you, because we see it literally every year. People will have a K1. It says ordinary income from these ATM machines, and the CPA just goes, that's non-passive. They'll put it on like Schedule E or Schedule C or something, and then you won't be able to use any of your losses to offset it. It's a real bummer. So just because it says ordinary income does not make it non-passive. If you're not materially participating in the ATM machine business, which I doubt any of you are if you're investing in those, then that's all passive income for you, which is great news, because now you can easily wipe that income out by investing in rental real estate, right? Also, on the flip side, though, we also see sometimes where the CPAs will say, oh, you have box 2 rental losses or income. That must be passive income, even if you're materially participating and a real estate professional. So you really got to make sure that you're working with accountants to understand this stuff, because there's a big risk factor there. You could really lose your shirt on the tax benefits.
So let's take a little break and let's just get into some questions, Chris. I think because we're having a lot in the chat box. And so I'll start off with a question I saw. I think is, can passive income be offset by stock market losses, Brandon? What do you think?
No. So passive income, passive losses, that is so you've got passive, portfolio, and active ordinary income. Passive is everything I just described. It's basically like business income. When I'm talking about interest income, capital gain from stock sales, or capital losses from stock sales, that is all considered non-passive. I know it sounds weird, but that's the way it works.
Okay. What about, can K1 losses be written off in the W-2 if just being an LP and not having reps?
Can K1 losses be written off W-2 if no?
Right, because
if you've got K1 losses and you're not materially participating in the activity that's giving you these K1 losses, then no, you cannot use it to offset your W-2 income. If you are a real estate professional because you have your own portfolio, and if you make a grouping election to group in the syndication investment, then now, yes, you can, because that will all be considered non-passive for you. So there is a way to kind of get around that.
There's a ton of doctors that are part of our investor circle, and a lot of them have sold things such as like surgical centers or medical office buildings or like dialysis centers. Can you tell me about how they can offset some of those taxes?
Yes, sir. That is our favorite thing to do with the physicians that we work with. I think roughly 30 or 40% of our clients now are physicians. The physician community loves us, I guess. But we love them too, because you guys have this really cool access that really nobody else has. And you have a tax court case that gives you authority to do this. It's Hardy versus Commissioner from 2012. So basically, if you invest in surgical centers, or any other type of center. Sorry, my sisters are physicians. I am not, so I don't know all the different centers. But if you have the ability to invest in them as a limited partner, or as a partner that's just not materially participating in the activity of the center, it doesn't mean that you can't take patients there. And that's what the Hardy case explored that I just gave you. But it means that you can't materially participate in the actual surgical center operations.
Okay, so they're not part of operations, but they're not part of operations, but they may be like referring patients there or something like that.
Yeah. Totally fine. Right. So if you're not materially participating, then all of the income coming from the surgical center is passive. And if we're reflecting on my whole monologue here for 20 minutes, passive income can be offset by passive losses from rental real estate. Right. So it doesn't matter if rental losses are offsetting it. It doesn't matter, because in the context of the passive activity loss rules, it's either a passive loss or it's passive income. It doesn't matter what source it came from. So rental losses can offset surgical center income. They can also offset the eventual liquidation, the gain on that liquidation when you sell it. That's all considered passive income for these rules. So yeah, you can invest in rental real estate and you can offset it. And if you have, sometimes we run into accountants, they're like, no, that's not possible. Go look at the Hardy case. It's there. It's already been litigated. The taxpayer won. So,
I think there's about $2 to $3 million of tax savings we're providing to investors in our latest deal because of what you just said. That's amazing.
Yeah, it's incredible. It really is.
Okay, here's a question. Someone's asking about an amount. So if you have an investment of more than 10 million, is there an easy way to become a professional real estate investor? So I don't know if that's a tax question.
I can frame this one a little bit better. So really what they're looking for is, if you're primarily a passive investor, but you've invested in $10 to $12 million of passive investments, and in many of those, you've either become a co-GP, or you've signed on loan docs, or you've participated to some extent, but maybe not enough to get rep status. Is that helpful in getting rep status?
It depends on what other activities you have going on in your life. So if this is all you're doing, then I think I would lean more towards it's possible for you. If you are also a physician, or if you are also, I don't know, a big nonprofit person and you're running the nonprofit, you don't have to necessarily be making money, but if you get audited for this, the first question the auditor is going to ask you is, tell me about your life. What all do you do every single day? Right. So if you're doing a whole lot of other things and you're co-GPing on the side, it's going to be a tough sell.
Well, and I think I know who asked this question, and I think for them, they own like quite a few urgent care clinics. And, it's a husband and wife, and one of them is the doctor that works in the urgent care clinic, and the other person doesn't really participate. They might have some small level of payroll and help with a few things, but for the most part, they're focused on the passive income, and that's their main role. And the other person is the physician that's operating the urgent care clinics. And that's, they're hoping to figure out a way to get reps or to qualify for reps.
I think it depends on it. So you maybe, I think that it depends on how those urgent care centers are held, how they're structured. If they're triple net, it's going to be super hard. But if they're not triple net, or if you're somehow heavily operating it, then there's a chance. But typically in those cases, there are easy ways to build a portfolio that gets you over the hump. And so the real question is just like, do you need to do that, right? Should you buy something locally that you have to rehab, and then rent out afterwards, because you could very likely get the hours there, and that might not be worth it for 100K in losses, but it might be worth it for 3 million in losses, right? So very facts and circumstances based. Our firm does this type of analysis all the time. This is not uncommon for us. So if you,
Yeah, I'll certainly connect you. I know they're
okay.
Cool.
So here's another question, Brandon. Does my bonus depreciation from Viking Capital or any other syndication that I'm part of offset any capital gain that I received from selling my private practice to venture capital?
probably not, because your private practice is probably going to be considered non-passive. It'd be like if I sold my CPA firm today is non-passive because I'm materially participating. If I know that I'm going to sell my CPA firm 10 or 15 years from now, I could actually take actions today to stop materially participating so that when I sell, it is considered passive. And then, yes, the gain on sale would be able to be offset by all the rental losses. A lot of people don't do that, though. And because they don't do that, when they sell, it's all considered non-passive. Even though it's a capital gain, it is considered non-passive. So you can't use the losses, the losses from rental real estate to offset.
And this is this is for someone asking for your crystal ball. If everything of bonus depreciation is being phased out after the fifth year, do you anticipate any new tax strategies coming along that are going to either replace bonus depreciation? And you talked about it may being extended, but if it doesn't extend, is there some talk about anything new taking its place?
No. I mean, Congress is not in the business of creating tax strategies for people. Congress is in the business of balancing budgets, right? So they're in the business of getting reelected and balancing budgets. There are Congress people, men and women, that get reelected on the merits of cutting taxes, and whenever they do that, you see bonus depreciation and things like that come into play, right? So you can get a recent history lesson with the 2017 Tax Cuts and Jobs Act and everybody that was involved with passing that legislation. So if those people are the majority, then you'll see more cuts to taxes, more new laws implemented that enable people to cut taxes. But if those people are not elected, then you won't see any changes.
So the next question I have is, people always love to ask about the vehicles. So here's the vehicle question. So if you have a vehicle over 6,000 pounds for personal versus real estate in terms of percentage use. So basically they're asking how to write off cars. So maybe we can get, it wasn't very clear on the question, but I think that's what they're getting at.
Yeah. So if your gross vehicle weight rating is above 6,000 pounds, and you use the vehicle 100% for business, then you can deduct 100% of the cost through Section 179 and bonus depreciation, either or a combination of. What happens when you do that, though, you also have to use the vehicle more than 50% for business every year for the next 5 years. So otherwise, you have to recapture. What happens is people will try to write off 100% of the vehicle, even though they haven't really used it 100% for business. We typically don't see people successfully write vehicles off unless their business has bought the vehicle and it's truly just for business purposes. Some of our clients will buy trucks at a location where all their rentals are, and so they'll drive up and then they'll use the truck driving around, and that's doable too. If you're thinking about buying like a Lamborghini Urus or whatever it's called, to show your friends, and be cool, this is not a strategy for you. So,
and then the other thing is, can you lease a vehicle?
Yep.
Through the business. Yeah.
Yep, absolutely. You can lease a vehicle through the business. Part of it will be deductible. Part of it will not be deductible, depending on your personal versus business use. Yes.
Okay, cool.
So Brandon, one of the questions that someone had asked was, and you kind of mentioned this earlier, if somebody is going to do a cost tag on their own on a property that they own, small multifamily or a single family rental, and and they bought it several years ago, like 2020. If they do a cost seg several years later, can they use that bonus depreciation then? And do they get the amount of bonus depreciation that was allowed to be captured in that year that they bought it? Or is it when they do the cost seg?
Great question. So if you're tracking, we've got these rules that prevent us from using all the tax losses today, right? And I could use the tax losses if I'm a real estate professional and if I materially participate in my rental activities. So I know that if I can qualify as a real estate professional and materially participate in my rentals, then I will be able to use rental losses that are created for me in that tax year that I meet those tests. Well, to qualify as a real estate professional and to materially participate, there's a whole bunch of quantitative tests. It's all about tracking hours, and you got to make sure that these are like real legitimate hours, not education, not research, not investor level hours. Like it's gonna be real operating. I'm managing the property. If you can do that, and if you can qualify as a real estate professional and materially participate, then all of your rentals will be non-passive. So if you had purchased a rental a few years ago while you were still working full-time at your physician job, and if now in 2023 you have qualified as a real estate professional and you are materially participating in that rental and all your other rentals, you can retroactively cost segregate that property that maybe you purchased. Let's call it 2020. You purchased it when all the COVID crazy stuff was going on, right? You can cost segregate that today. And even though 2023 is an 80% bonus depreciation year, 2020 was 100%. So you can use 100% bonus depreciation on this property that you bought and placed into service back in 2020, and you can apply all of that depreciation to 2023. So yeah, it's a sweet strategy to, if you know in a few years you're going to be retiring, going part-time, doing something different, going into real estate full-time. If you know in a few years you're going to do that, you can buy your rental properties now and you can just slow roll it. It doesn't have to be a sprint. We don't have to deploy millions of dollars. We can pick up a few properties here and there. We don't cost segregate it, and then we do cost segregate it at some future point. Or if I know in 3 years I'm going to sell my physician practice, there you go, right? I'm going to start buying property today because I'm going to get 80% bonus depreciation if I buy it today. Even though I'm not taking that deduction today, I'm going to take it at some later point. Whenever I decide to take that deduction, I'll be able to claim that depreciation. So if I know I'm selling my physician practice for something big later on down the line, maybe I sell my physician practice in March of whatever year that is. That gives me a whole 9 months to figure out how to qualify as a real estate professional and materially participate in my rentals. And if I can do all that in the same calendar year, I can retroactively depreciate or cost seg and bonus depreciate all of these properties that I've been acquiring along the way. So yeah, huge strategy.
Doesn't have reps, would they still be able to do that and only use it against their passive income? If they had other passive income to offset?
Yeah. So the cost seg study and the bonus depreciation is simply the act of creating the tax loss. And then the question is the tax loss passive or non-passive? Yeah. So if I've got like surgical centers that are selling or whatever, and I've acquired all these properties along the way, well, if the surgical center is passive, I can do the same thing without qualifying as a real estate professional. Yeah.
So along those same lines, guys, we have our last deal of the year, Stewart's Mill, 1988 vintage property, 188 units. I think we're at 98% filled on this deal. So there's a few more slots left for people who want to get in, but it's a great time because I don't think there's that many deals in the country going on that are still live to take advantage of this 80%, bonus depreciation we've been talking about all day today. And again, there's multiple ways to slice that. But Brandon, can you speak about, let's say people invest in this thing, they capture the tax benefits of the bonus depreciation, and in like, let's say in 3 or 4 years we sell it. Now, if we do something called a 1031 exchange, there's no recapture of the event. We're just going to keep rolling that benefit to the next deal.
Correct.
And obviously you can language it better, but that's sort of what it's a phenomenal tax strategy, right?
Oh yeah, no, you got it. It's Monopoly. Remember we played Monopoly as kids? Like you got the 3 green houses and you trade it for 1 big red hotel. That's what the 1031 exchange is, right? We're just trading up and we're kicking all the gain, all that recapture down the road.
So essentially, you can play this as an infinite game, and it's and the name of the game is swap till you drop. So between the these two tax strategies, the 1031s plus the bonus depreciation, you can really be very tax efficient and achieve a lot of your wealth goals.
That's true. You got to die at the end though. You got to actually drop, right?
Yeah.
It's great. It's a great strategy.
Chris, one last question for Brandon before we let him go.
Let me see. I think, we got a lot of them.
Anything
let me leave you guys.
Brandon? Yeah.
What's that?
Anything overlooked that you think you can recommend to our investors that they should do? Like a little
so you guys had a slide on it that I couldn't get to because I know I monologue about passive activity loss rules, so I apologize. But the most important form in your tax return, I know when you get your tax return from your CPAs, it's like 700 pages long, and you're like, what the heck am I looking at, right? The one form that you should look at is Form 8582. I'll say it again. The one form that you should look at is Form 8582. If you don't know where to find it, you can just Control F if you're using a PDF and 8582. That form tracks all of your passive activities, passive income and passive losses, and your suspended passive losses. Okay, so that form will tell you your total suspended losses that you're carrying forward and can use in the future. When you don't track that number, and when you switch accountants, we have seen the new accountant forget to look at the old tax return and plug the suspended losses into their software. It's a manual process, unfortunately. Tax software is millions of years behind the times. So we have literally seen hundreds of thousands of dollars of suspended passive losses just literally disappear off people's tax returns. So your job every year is to put a calendar event in your calendar on like April 20th and go and look at Form 8582 and go into some spreadsheet where you're tracking it every year and put in the number of suspended passive losses you're carrying forward, because you don't want your accountant to miss that. They're not bad people. It's just the nature of tax season. It's just crazy. So help them out to make sure that they don't miss that number, because it would really, we had a client that their prior accountant literally wiped out $700K of loss. It's just gone. And that's not a fun conversation to have. Form 8582, it's the number one tax form in your taxes that you need to watch out for.
Awesome, man. Thank you so much, guys. All right, guys. Thanks for joining us for this webinar. Again, join us at vikingcapitalinvestments.com or vikingmultifamily.com for latest information on the deal. There's a link in our chat. Our team put a calendar link there if you want to talk about tax and wealth strategy with our team. We're here to help. Brandon, how can people get to know and find out about your firm?
So you can go to www.therealestatecpa.com. You're also welcome to just email me, and I'm throwing my email in the chat here, brandon.hall@hallcpallc.com. If you email me, I'll just give you a heads up. I have an executive assistant who is phenomenal. So she will most likely help you get connected with the right person in the firm. But if not, I will. So feel free to hit me up if you've got any questions, or especially if you are that real estate professional status person, and you want us to take a look at that. That sounds super interesting. So yeah, thank you guys. I appreciate your time.
Yeah. Brandon, thank you so much. Chris, thank you so much for hosting. And guys, have a good night and happy holidays.
Bye, everybody.